Over 80% of retirees make this RMD mistake. Now, what the heck is an RMD? Required minimum distribution. This RMD is something you must take from any account if it is a pre-tax account or if you've inherited an account. So who does this not apply to? Because I make all these videos to try to give you all guidance, but part of my job is to tell you what not to worry about. So pretend all of your money is in a brokerage account right now. This video does not apply to you. You don't have to watch it. If you want to watch it to learn and get educated, awesome. But you're not going to have to worry about it. Going, should I apply? When is it that I need to withdraw? Doesn't matter. If you have a Roth IRA, doesn't matter. If you have a pension, doesn't matter. Now, if you go, I have a 401k, oh yeah, I save money to a 401k, you're going to want to watch this. If you have an IRA, if you inherited an IRA, this video is for you. So with that being said, RMD stands for required minimum distribution. Now, most people, when they hear this, they go, okay, what's the issue? Well, for a lot of people, they've saved and invested really well. Pretend you have $1 million in your 401k and you're 60. If that keeps growing, maybe it's 2 million, maybe it's 4 million. When you reach age 75, for most of you, some of you it's a little earlier, 73, but 75 for the majority of you, that's when you're going to be forced to take out money from that account, whether you want to or not, from a pre-tax account, like a 401k or an IRA, an account that when you put money in, you got a deduction, it grew tax were deferred, and now when you take the money out, you have to pay taxes. So what the IRS is not allowing you to do is it's not allowing you to just let it keep growing and growing and growing. They're forcing you to take out a portion, and that grows every single year. So what's the issue? The issue is, for a lot of people, if you don't do any planning, if you don't do any Roth conversions, if you don't spend enough money, which sounds weird, what can happen is your $4 million, you're going to have to take out, and this starts at 3.8% today. So I'm just going to do some basic math with literally my iPhone calculator, nothing fancy here. If I take 3.8% of a $4 million portfolio, just as an example, it's not exactly that. It's about 152, let's call it 150,000 a year. So you might have 150,000 a year that you have to take. That is all taxed at your highest marginal bracket. You're also going to have Social Security, more than likely. At the same time, there might be rental income or inheritance. So you might have $200,000 plus coming in, and you might be going, we don't need $200,000. We need 100 so we can live. Well, the rest is getting taxed at your highest bracket. So what a lot of people do is they go, hey, can I get strategic? Can I move money so that I don't get taxed as heavily? Right now, I just retired. I'm 60. I'm in a low tax bracket. I don't have any other income because I just retired. Maybe I start moving money from my 401k or my IRA into a Roth so that in the future, I don't pay 30, 40% taxes. I'd love to pay 10, 20% today if that's possible. That's called Roth conversions. So that's how you can protect against this RMD issue. I want to go deeper now on what are these RMDs so you can really see what are the mistakes that people make so you don't make them. Now, if you don't already know, my name is Taublieb. I'm a certified financial planner, host of the Early Retirement Podcast. This is all I do. You're never going to see me make videos on here's the best new credit card or a travel hacking tip, and that's not my thing. My thing is early retirement planning. What are these big things that really make a difference for your retirement? So check this out on my screen here. You're going to see what are the most common mistakes. Well, failing to take it on time or from the right account. These are big deals. I hope that you can read this and go, I'm never going to have to deal with it. But if you miss an RMD, the IRS can impose a 50% penalty on the amount you should have withdrawn. For example, if you forget to withdraw $10,000, you might owe an additional $5,000 in penalties plus taxes. So how do you avoid it? Well, in terms of ages, for you to know, when do they start? For most of you watching these videos, age 75 is the current rule. If you're born between 1951 and 59, 73, and beyond that, 70 and a half. What is the deadline? Your first RMD must be taken by April 1st of the year after you hit your RMD age. After that, it's December 31st. So it's a little bit more lenient at the beginning. Where does this apply? Okay, so Roth IRAs do not require RMDs, neither do brokerage accounts. So you must take them from tax-deferred accounts like a traditional IRA, a SEP IRA, a simple IRA, 401ks. There are some exceptions. I'm not listing every single one, but if you're still working and not a 5% owner, and once again, this is a common thing, you can aggregate RMDs across multiple IRAs, not across 401ks. What the heck does that mean? Okay, so What you could not try to do is go, well, I have a 401k over here and I have a 401k over here. Maybe if I am really strategic, I can like not tell the IRS about one of them and just like not pull. Or maybe I get more strategic, and obviously I'm being joking here, but maybe I'll just pull extra from this one because this is like a really big one, and then like I won't do anything to the other one. It doesn't work that way. Now you can see here, you can aggregate RMDs across IRAs. So if you had one IRA over here and one IRA over here, what you could do is that all gets looked at together. That's what aggregated means. You can't do that for a 401k, which means if you have a 401k over here and a 401k over here, and this one's really big, you can't only pull from that one. You're going to have to pull from both. With an IRA, if you have a big one over here and a small one over here, you can only pull from this one if you want because it's all looked at together. The other thing, now what I obviously want to talk about, how do you avoid overpaying taxes? So consider Roth conversions before RMD age to lower these RMDs. This is something that a lot of people go, come on, is this like really a big deal? Do people really worry about this? Well, I'm about to show you right now a real life example because this shocks most people. Most people go, come on. I mean, this sounds like a good problem. I mean, you're going to have too much money. Yes, it's quote unquote a good problem, but it's a real life problem. And I want to show you a sample of someone that I spoke to who went, wow, I'm going to really wake up to this. Before I show you that, here's two other things. Now, this is called a QCD, a qualified charitable distributions. What this means is if you want, you can move money from your 401k or IRA for charitable purposes, and that you can start doing. And the benefit of doing so is that will lower your RMD. Why? Because there's less of a balance in your pre-tax accounts. And then this is trying to be strategic here. Can you spread RMDs across the year rather than taking lump sum? Here's an example I'm going to show you. So this is a real person. I'm just changing their name for security purposes. They are 58 and 50, a child who's 19. They currently have a 401k with $1.4 million. Now, when we talk about goals, how much they want to spend, for them, they were discussing $12,000 a month, maybe another $10,000 a year on vacations. Let's just say hypothetically for a second. They're like, hey, we're really frugal people. $6,000 a month, that's totally fine for us. If we click retirement here, and everything I'm showing you guys right now, this is all at your disposal. You could go in and build your own plan with everything you're seeing here. If we go to, I want to show you cash flows. If we go to retirement, we go to cash flows. Don't worry about this number here. Actually, I do need to shift one thing here because before I was playing around before I got into this call. It was at $12,000 a month. So if they, once again, based off their assets, wanted to spend a certain amount of money, you can see as of this current plan, they'd be on track for $2.3 million at the end. Once again, go run your own numbers. Why am I telling you this? I'm telling you this because I want to show you what their required minimum distributions would look like. So here's a real life plan, okay? They're 58 and 50. They make $194,000 a year. If they retire in 4 years, there's no more income. You see all these zeros? That's kaputs, okay? Plan distributions. What the heck is that? That's an RMD, okay? See how that says 0 right now? That's because they don't have to do this thing. When do they have to do it? You guys remember the age? Put it in the comments. 75. You see this get turned on right here in 2042? So their RMD starts at $73,000 a year. Then it goes to 78, then 83, then 89, 96, 105, and so on. Now, what's this income? Well, this is their Social Security. Okay, so their Social Security is getting turned on at 67 for one of them, then the other spouse. So let's fast forward. Let's pick 2044. They're going to have $102,000 coming in, 2 Social Security benefits, 83,000 RMD. $186,000 is coming in the door. Their expenses are $152,000 adjusted for inflation because once again we're 20 years out. They have to pay taxes, which means they need 170. 186 minus 170, this 15, this gets taxed at the highest marginal bracket. So you see how this continues to increase? All of this gets taxed at their highest bracket, and they live in California. So this is too good of a problem, okay? Now, how do we fix this? Well, you could do things like Roth conversions. So you could go run different models and see, okay, does it make sense? Should we be trying to convert a certain amount of money? Meaning, what if we were to fill up the 24% tax bracket and our child inherits it and they're in the 15% bracket, just hypothetical. Here's potentially how much money it would add by doing this. You can see you can switch this, and if your child's going to be in a higher tax bracket, it'll make a Roth conversion more valuable. If they're in a lower tax bracket, it'll make them less valuable. So what we want to do is understand for our plan what's going to put us in the best position. Once again, if you want to do all of this, this is where you can get into the weeds. If you want to look at Medicare premiums, if you want to look at capital gains brackets and tax components, and you can have a lot of fun in here, okay? So this is all available in the description in what's called the Early Retirement Academy. I just wanted to make sure you guys were aware. Finally, want to make sure you understand, use your brokerage's RMD calculator or set up automatic distributions, double check your calculations. Most importantly, if you're really going to go through this, work with a CPA or fiduciary advisor. Now, my final fun announcement is we at Root, we do a lot of tax planning and we get a lot of questions about what does tax planning mean. So if you go to our website under resources and FAQs, if you scroll down, you'll see a lot of different questions here, but a big one is around tax planning and how we offer that. How do we handle it? So there's a big difference between what's called tax prep and tax planning. So what are we doing? We're helping clients identify Roth conversions, harvesting, charitable strategies, optimizing income to manage healthcare, all in coordination. While we don't file your taxes, we collaborate closely. If you want to watch a video on it, you can click this and you'll see me explain what that means. We are doing a lot. You can go see it in the FAQ section. If you want to work with Root, you can go here. We have a new option where if you click RE, you put in your information. Where'd you find us? Let's say it's, the podcast. And then you go, yes, you have over 2 million. That's our current minimum today. You can say, I'm still getting a sense. I don't really know if I need Root services. If you're like, no, I understand, I want to work with Root, you can click that. And if you have between 2 to 5 million or more, you'll be prompted to work with Root. You can see here, we launched our new priority path. This is a fast track experience. Okay, let me explain what this is like. If you've ever been to Disneyland, there's the long lines at Disneyland, okay? So you can pay for a fast pass. Now the fast pass, what does that allow you to do? You get to cut the line, right? No. We call it skip the line because you're not cutting, you're having to pay more money to cut the line. Yes, I recognize that, but we explain it as skip the line. So most of the time, if you want to skip the line, you have to pay money, like at Disneyland. At Root, which is better than Disneyland. Just kidding, I can't say that because Disneyland's the happiest place on earth, guaranteed. But the truth is, I like Disneyland, okay? So guys, don't make fun of me, unless you want to, in which case you go in the comments and have fun. But be nice about it, okay? I read the comments. It's fun for me to watch that. I just try to make all this free stuff to make it so you guys have a great life, regardless if you work with Root or not. That's why I make all the videos I do. So with that being said, this priority path, all we ask you to do is to review those FAQs I showed you on the previous screen, and you can immediately skip an introductory call and start working with Root. So you could click Start Priority Path. You can see this short video from myself. Make sure you understand how we work. All of a sudden, you can start picking your advisor. Some of you are going, I'm not sure. I'm sure everyone you have is great. If you want to learn about our advisors, if you go to rootfinancial.com and click About, you can actually scroll down here and you can see our advisors. You can learn more about them, see, okay, what's so interesting? Oh, Jeff has degrees in behavioral finance. That's cool. What's that mean? You can watch a video, learn about him. You can see what it is he cares about. He came and joined us. He was at Edward Jones. Then he went to Charles Schwab for 11 years. Then he joined Root. He might resonate with you. You might go, oh my gosh, he looks so cool and he's got the coolest shades. You want him to be your advisor. Some of you go, I would really prefer an advisor that specializes in working with business owners or someone that has the heart of a teacher. Stephen here, he is currently, you can see, wife and mother are both teachers. 4 of his other members spend their careers in the school system. He likes spending lots of time with people more than a lot of traditional advisors because he believes in strongly educating. So you can watch the video and get to sense of, okay, is Stephen the type of person I think I'd like or my spouse might like? So if you want to fast track the experience, a lot of people elect this new priority path because you don't have to wait months potentially for an introductory call. So I just want to make sure you guys are all aware of that option. That's it. I know today was a lot on required minimum distributions. I hope you enjoyed it. I love getting to make these videos. If it was helpful, let me know in the comments below.